Impairment. Impairment of an asset. What is meant by impairment? Impairment means whenever there is a sudden fall in the value of an asset, we book an impairment. How we will get that the value of an asset is decreasing? There are few indicators, internal indicators and the external indicators. What are the internal indicators or internal factors? Damage to asset means due to natural disaster or any destruction. Change in use of assets and plan to sell an asset means management is going to change the use of this asset. Means management is replacing the old assets with the new one. Also, management plan to sell this asset. And what are the external factors? External factors such as change in technology. Let's say we are dealing in assets which are technological based, and due to sudden change in technology, our existing assets will get impaired, means their value will go down. Change in legal and economic development. If there is any rules and regulation changes which have impact on our assets, due to which the value of our assets will also decrease. Increase in interest rate. If the interest rate is increasing, it will result in decreasing of value in use of our assets cash flows. Carrying value of an asset is greater than market capitalization. It means the market value of our company is less than the net assets value. Let me give you an example. Okay, now read from the content. What is an impairment? Sudden fall in the value of an asset. Let's say a carrying amount of EPE is 100,000. Minimum economic benefit. If the benefit is less than the carrying amount, it means there is an impairment. We will discuss with whom the carrying amount is compared. When to record impairment? Event based. There are two kinds of impairment: event based impairment and the annual impairment. Let's read event based impairment. Whenever there is a hint of impairment, internal factors or external factors, then we do impairment testing, then we get results yes, no. Internal factors, external factors. Internal factors such as damage to assets, natural disaster, change in use of assets, or plan to sell an asset. Change in technology, change in legal and economic development, increase in interest rate, which decrease in value in use. So if value in use is decreasing, it's also an indicator of an impairment. Carrying value of an asset is greater than market capitalization. Market capitalization is total number of shares multiplied by market price. Let's read an example. The value of equity means net asset is 70,000 and the market value is 50,000. Means individuals will prefer to acquire it at 50k. It suggests that investors believe the company is worth less than its net assets. Means carrying value is higher than the value of the company. It means our share price is decreasing. Now, there is a difference between depreciation and impairment. Depreciation is the systematic allocation of cost over its useful life, means cost divided by useful life is the depreciation. Whereas impairment is sudden fall in the value of an asset, and how this value of an asset falls due to these indicators. Now move how to record an impairment. We compare our carrying amount with the recoverable amount. There are three steps. First, if there is an indicator, these indicator, it means we will going to book an impairment. How we will book an impairment? We calculate the recoverable amount. Recoverable amount is the minimum economic benefit, which is higher of two things: value in use or fair value less cost to sell. Whichever is higher is our recoverable amount. And the step 3, sorry, this is step 3, we will book impairment. There is an hint for you. Whenever carrying amount is greater than recoverable amount, impairment is must. I am reading again. Whenever carrying amount is greater than recoverable amount, impairment is must. Recoverable amount is our minimum economic benefit. Now Move to the next slide. Annual impairment. First, we have discussed event-based impairment. Now, annual impairment. There are few assets on which annual impairment will be tested. Intangible assets with indefinite life means infinite life. Brand. Internally generated goodwill means goodwill which we have generated internally. Intangible assets not yet available for use, such as formula for any prescribed drug which is not in market. Now there is a scope of IAS-36. It is very important. IAS-36 is not applicable on assets 1 and 2. 1 with their own impairment criteria. IAS-2 inventory. In inventory, we record inventory at lower of cost or NRV. So in IAS-2, we never booked impairment as per IAS-36 because inventory has their own standard which is IAS-2 lower of cost or NRV. IAS-12 deferred tax. If there is any taxable or temporary difference or convenience difference, this will be accounted for as per IAS-12. So no IAS-36 is also applicable on IAS-12. Now IFRS 9. IFRS 9 also has an ECL model. We will discuss once we read IFRS 9 and IFRS 5. IFRS 5 also has their own specific criteria. So these are the standards or assets you can say on which IAS-36 is not applicable. Also assets recorded at fair value with changes taken to P&L such as investment property IAS-40 because whenever there is a change in investment property value we take into profit and loss account. So it's automatic and impairment. IAS-41 agricultural asset. Whenever there is a decrease in the value of agricultural asset, we take into profit and loss account. So it's automatic impairment. Note, reason of an impairment need to be disclosed in notes to the financial statement. Means you have to write the indicator due to which impairment is recorded. Now, read the recoverable amount component, which is fair value. Recoverable amount is the higher of fair value less cost to sale or value in use. Whichever is higher, we will take as a recoverable amount. What is a fair value? Fair value is the bid price. Fair value is the bid price of our assets. Price on which market participants willing to purchase the asset. Let's say ABC entity wants to sell its pen at a price of 200. This is offer price. Offer price means ask price. ABC wants to sell its pen at their own price. So this is an offer price. To similar new pen is in the market at price of 250. This is replacement value. Market value means the same nature of the pen is available in the market at the price of 250. Now, market is willing to accept the ABC entity's pen at 160. This is a bid price. So in this case, what is the fair value of the pen? Of course, this one 160 because the market participants is willing to accept the ABC entity pen at 160. Okay. For non-transferable assets such as franchise license, logos, fair value is irrelevant. Why? Because there is no active market, so we can't calculate fair value. That's why fair value is irrelevant. In the above example, means in this example, what is the fair value in this case in order to calculate the impairment? It's a bid price that is 160, this one. Now move to cost to sale. Cost to sale, only incremental costs are included such as costs incurred in order to transfer an asset from factory to market such as dismantling, transportation, brokerage, additional employee cost and legal cost. Interest cost and income tax not included in cost to sale. Move to the third slide. What is value in use? Value in use is the present value of the future cash flows expected to be derived from an asset or cash generating unit through its continued use means entity is continuing to use its asset and its ultimate disposal means entity is completely used its asset. Now entity is disposing, ultimate disposal at the end of its useful life, completely used. Now we have just discussed if there is an increase in interest rate, then this is an indicator of impairment. Why? Because of this thing, when the interest rate is high, it reduces our cash flow. So reduction or less value in use is also an indicator of an impairment. Costs that are not included in value in use calculations, such as interest cost, tax, future overhauling inflows due to overheads, because not sure overhauling will be done or not. So that's why we will not incorporate these costs in calculating the value in use. Receivables and payables pertain to past cash flows, because we are going to calculate the future cash flows, and only those costs are included which are, or which we have proper authentication or accuracy that such cost will be part of this cash flow. Also, no improvement automate charges. Important things with regards to value in use. These are the things which you will get in your exam questions. So be attentive while reading these things. For value in use, take cash flows of next 5 years only. Sometimes the examiner asks you to take the cash flows of less than 5 years. You will have to write, no, it's not a valid justification. Use 5 years cash flows. You can use more than the 5 year, but if you are going to use more than the 5 year cash flows, let's say 7 year or 9 year, then you will have to disclose the reason. Point two, use decreasing growth rate for future cash flows, because if you are using higher growth rate, then your cash flows might be out as cash flow, future cash flows based on estimates and assumptions. If whole industry is recording impairment and you are not, then disclosing the reason of not recording the impairment even though the entire industry is recording. If there is any negative variance in past cash flows, incorporate it in current analysis. If there is any negative thing in past trend, then you will have to also incorporate in your current analysis. Disclose the assumptions used in preparing the cash flows. You have to disclose the assumptions, because assumptions involve subjectivity and estimates. Now, which discount rate to be used in calculating the value in use? Which discount rate should be used? Always use project specific discount rate. You have studied in your F9 exam that for every project there is a specific discount rate. If there is no project specific discount rate, then you will use current market interest rate with inclusion of currency risk, country risk, etc. On current WACC. Okay. There is a few lines which I have copy pasted from your past papers. Discount rate should not reflect the risk for which future cash flows have been adjusted, and should equal the rate of return which investors would require if they were to choose an investment which would generate cash flows equivalent to those expected from the assets. I know you are not getting this thing. That's why I have explained in simplified version. The discount rate should not double count risk, should not double the count risk. If risks are already included in cash flow estimates, don't include them again in the discount rate. You have studied WAC, beta, all these things, RF, RM. The rate should reflect what an investor would expect to earn from a similar risky investment that gives the same kind of cash flow as this asset, because we have to keep in mind that investors are our major stakeholders. So while incorporating the rate, we have to make sure that investors will not affect by this thing. Okay, there is a difference between impairment and revaluation. Impairment, it must, even if you are using cost model, whereas revaluation, it's an option. It's up to you, you are using the cost model or the revaluation model. But if you are using a revaluation model, then entire class of assets will be revalued. You can't choose, let's say you have a 7 asset and you are going to revalue 5 and 2 are cost model. No, it's not valid as per IAS-16. You have to revalue entire 7 class of assets, or you have to valued your assets on cost model. If you are using revaluation model, then use revaluation model for entire class of assets. Impairment loss is a genuine loss, whereas revaluation loss is an assumed loss. Now move to the fourth slide. Reversal of an impairment. A reversal of impairment. Let me give you a brief overview about reversal of an impairment. What is a reversal of impairment? Let's say in the first year we have an impairment loss of 5 million, and in the next year the fair value or the recoverable amount of our asset is greater than the carrying amount. Now in this case we don't have any impairment loss, even though we have an gain. So we have a gain of 10 million, and last year we have an impairment loss of 5 million. So now we can adjust our last year impairment loss by this year gain. So the net balance, net gain we will have is 5 million. Now read. A reversal of impairment happens when an asset that was previously written down, impaired, recovers value in a later period, means next period. So you have increased the asset's carrying amount again, but only to the amount it would have been if no impairment had happened. Example, entity A has a land whose carrying amount is 30 million and the recoverable amount is 20 million. There is an impairment loss of 10 million. 30 recoverable amount is higher, and carrying amount is higher and recoverable amount is lower. So it means there is an impairment of 10 million, carrying value less recoverable amount. Next year the recoverable amount is 40 million. Next year the recoverable amount is increased. Now the net book value of the land this year is 20 million. Why 20 million? Because last year we were at 30 and due to an impairment we reached at 20. So this year the land carrying value is 20 million and the recoverable amount is 40 million. So it means recoverable amount is higher. So there is a profit, or you can say gain, of 20 million. So here we can reverse our previous impairment of 10 million. This is called reversal of an impairment. Now we are left with 10 million net gain, because 10 million impairment was set off from this 20 million. Okay, there are two models. In IAS-16, we use cost model or revaluation model. Let's start with the cost model. If there is a cost model, then how you will reverse your impairment? In cost model, reversal of impairment is possible till the extent of historical carrying value. Historical carrying value means cost less accumulate depreciation. Historical carrying value if there had been no impairment in past. It means you will calculate the carrying amount by just reducing or deducting the depreciation. You don't need to reduce any impairment in this case. Let's read an example. At year 1, the cost of the asset is $1,000 and the life is 10 years. The recoverable amount at the end of year 1 is 630. Now there is a cost of $100 less depreciation, 1000 divided by 10 because life is 10 years, so 100 depreciation. Carrying amount is 900. This is carrying amount at the end of year 1, and at the end of year 1 there is a recoverable amount of 630. Now there is an impairment. Why? Because recoverable amount is lower than carrying amount, so there is an impairment loss of 270. Okay, now in the start of year 2 means in the next year the assets value is 630. Why 630? Because we have booked an impairment of 270, so we reach from 900 to 630. So in the second year the asset stand at 630, as last year it was impaired At the end of this year, the recoverable amount of the asset is 600. This year, the recoverable amount is 600. Okay. Net book value is at start of year 2 is 630. 630. Now you will have to book depreciation. 630 divided by 9. Why 9? Because 1 year has passed, so now the life is left for 9 years. So 630 divided by 9 is 70. 630 minus 70 is 560. 560 is the carrying amount at end of year 2, and at end of year 2 the recoverable amount is 600, means it is greater than 560. So there is no impairment. Why? Recoverable amount is higher than the carrying amount. So it means there is no impairment. But there is a reversal of 40. There is a reversal of $40. Our impairment loss is 270. This one last year, and this year we have no impairment loss as the recoverable amount is higher than the carrying amount, so we can reverse the impairment loss of 40, means from 270 we can reverse 40. So the remaining impairment loss will be 230. Why 230? Because we have a $40 gain and 270 is impairment loss. So out of 270, we reverse 40. So now we are left with 230. Okay. Carrying value, if there had been no impairment, means original book value. I am reading this thing in the context of cost model. Carrying value, if there had been no impairment, means original book value. What is original book value? It's 800. How 800? Okay. 1000 is the cost. 1000 is the cost, and the life is 10. Sorry, not 100. It's 10. Multiply by 8. Why 8? Because 2 year depreciation is reduced. So I have taken the remaining month, 8 months. If you want to calculate the depreciation, then instead of 8 you will write 2, then you will get 200. Then you will have to deduct 200 from 1000, you will get this figure 800. But I have calculated it directly, so I get the carrying value figure. How? 1000 divided by 10 multiply by 100, it's 800. Carrying value, if there had been no impairment, it means we can reverse the impairment till 800 from carrying value of 560. What is our carrying value at the end of year 2? It's 560. So from 560 to 800, we can reverse our impairment. But we have only gain of 40. That's why in this case, we only reverse the $40. Now, what if the historical carrying value is 600 and the recoverable amount is 800? In this case, we should again reverse the impairment till historical carrying value, that is 600. It means in the cost model, you can only reverse your impairment loss till the extent of historical carrying value. And how you will calculate historical carrying value? You will calculate by this formula. Once you calculate your historical carrying value, then you will have to compare your carrying amount with the historical carrying value. Then you will get the difference. Let's say in this case the difference is 800 minus 560 is 240. So it means you can reverse your impairment of 240. But here we have only 40 gain. That's why we just reverse the 40 gain. What if we have 240 gain? Then of course we can reverse 8 by 240. What if there is a gain of 250? So what do you think? Can we reverse 250? No, we can't reverse 250 because we can only reverse till the extent of carrying value, and the extent is in this case 800 minus 560 is 240. Now, what if the historical carrying value is 600 and the recoverable amount is 800? I have just shifted this case. In this case, the historical carrying value is 600 and the recoverable amount is 800. In this case, we should again reverse the impairment till historical carrying value. We can't access above the historical carrying value. Historical carrying value is the restriction, is the cap. I hope you are getting the things. If you are not understanding, you can ask me on WhatsApp or you can comment down below the video. I will explain it to you. Now we have a revaluation model. In revaluation model, reversal of impairment is possible till the extent that you have booked expense in past with the inclusion of effect of reduced depreciation. This is a very important and interesting topic. Okay, let's read from an example. At year 1, the cost of the asset is 1000 and the life is 10 years. The recoverable amount of the end of year 1 is 720. This is actually a fair value because we are using a revaluation model, and in revaluation model we calculate or book revaluation loss or revaluation gain based on fair value. So recoverable amount is the fair value. Okay, cost 1000, life 1000 divided by 10, rate depreciation 1000 minus 100, it's 900 carrying amount at the end of year 1, and at the end of year 1 the recoverable amount is 720. So it means there is an impairment loss or revaluation loss of 180. Now in the start of year 2, the assets value is 720 as last year it was impaired. At the end of this year, the recoverable amount of the asset is 1200 due to increase in fair value. This year, the value is increased by 1200. So, start of year 2, 720, you will depreciate it by 9 years. Why? Because 1 year has already passed. So, 720 divided by 9 is 80. Now you will get 640. Okay, 640 minus 1200 give you a revaluation gain of 560. Now you have 560 revaluation gain and 180 impairment loss. Out of 180 impairment loss, there is a reduced depreciation. How reduced depreciation? Last year we booked depreciation of 100 and this year we booked depreciation 80. So depreciation is reducing. When there is a reduction in the depreciation, it means our assets value is increased. So this 20 difference will deduct it from this 180. So our net impairment loss will be 160. Now read this thing. Our impairment loss is 180, but there is a reduced depreciation as last year depreciation was 100 and this year it is 80. So $20 is a reduced depreciation impact which increases the assets value. So we have to deduct it from 180. Now the impairment amount is 160. 180 minus 20 is 160, which we can reverse as we have a revaluation gain of 560. Total revaluation gain is 560. So we debited 560 PPE and revaluation gain is 400. How 400? Because there is an impairment reversal of 160. How 160? 180 minus 20, 160. So the net figure is 400, which goes in OCI. I hope you are getting the things and you know that revaluation gain is reported in OCI, other comprehensive income, and the impairment reversal is booked in profit and loss account. Okay, assets for which no reversal of impairment. There are two assets for which no reversal of impairment. Purchase goodwill once written off can't be reversed because now it will be internally generated. Once your purchase goodwill is write off, so it can't be reversed, then you will have to generate it internally. If recoverable amount increased because of time value of money, unwinding of discount, no changes in cash flow, no change in timing of cash flow, reversal not allowed here because it's not a real reversal. It means there are no such changes in the cash flows. These are the assumptions which management used to reverse the impairment loss. So these are not an actual reversal. Okay, now cash generating unit. This is very important and the last topic of today's IAS 36. Cash generating unit, smallest group of assets that generates independent cash flows. Assets alone can't provide earning, it must be in group. Means single asset you can't calculate cash flows for the single asset. That's why it must be in group. Example, classroom subsidiary. A single classroom can't help you in generating revenue. There should be proper light, proper ventilation, proper tax tables, etc. Sorry. Table alone will not generate cash, so it's not a CGU. But if this table is in classroom, then whole class combined will generate cash, then it's a CGU. We bought company A, and company A has three different business in three different cities, so company A has three separate CGUs. It's difficult to calculate the separate value in use for individual asset. That's why CGU is formed, because we can't calculate the value in use for individual assets. That's why we built a CGU. Steps to solve CGU questions. Obvious impairment means if the examiner say that building or plant is impaired by this, then you have to write the impairment of obvious impairment. Then write of the goodwill. Remaining impairment to be option on remaining assets on prorate basis. Do not impair cash and current asset. I hope you know these things. We remove goodwill. Why we remove goodwill first? Because if company is facing liquidity issues, then the first thing which is affected is the goodwill. That's why it is removed earlier. Goodwill is the major and the most important thing for any organization. Question number one, cash generating unit carrying values goodwill 5,000, plant 10,000, building 20,000, when 5,000, cash 2,000. Cash is a current asset, so do not impair cash and current assets. Total value of these assets is 42,000. Recoverable amount of entire CTU is 33,000. Recoverable amount of van is 4,500. Even though this amount is also included in this amount, but examiner gives you separate, so there is something why the examiner gives you this figure separately. Now, how you will solve these type of questions? You will have to make this table. One, description goodwill, plant, building, van, cash, total carrying amount. You will have to write all these carrying amount, which is equal to 42,000. Then first you will have to cancel your goodwill. Entire amount will be written down in impairment column, so it means there is no net amount, it's zero. Then you have to put the complete cash, or you can say current amount balance, to the last column, which is your net amount or recoverable amount column, because we can't impair current assets. Once you've done these two things, then there is another thing. Recoverable amount of when is 4,500. So it means when recoverable amount is given, so you have to write 4,500. Then you will have to calculate the impairment. How? 5,000 is the carrying amount and 4,500 is recoverable amount. So the impairment is 500. Once you write down the impairment of van and the goodwill, so you will have to find the total impairment. How will you find the total impairment? Recoverable amount is given, which is 3,300, and the total carrying amount is 42,000. You will deduct 43, 42. Its impairment value is 9,000. Okay, so now you will have to allocate this 9,000 between two assets, plant and building. Remaining impairment is 3,500. How? 9,000 minus 5,000 minus 500, because 500 we have already calculated and goodwill we have already put into impairment. So now we are left with 3,500 impairment amount. Allocate 3,500 to plant and building based on their carrying amount. Plant and building total carrying amount is 30,000. How? 10,000 and 20,000 is 30,000. Plant 10,000. This plant's value of 10,000 divided by the total of both plant and building, which is 30,000, multiply by the remaining impairment 3,500. You will get the impairment of plant, which we have written down here. And same goes for the building. So once you write down both the figures, then you will have to less impairment, you will get the recoverable amount. If you add all four figures, you will reach to 33,000. Now this is all for this topic. but I have write down few past paper things on the next slide, which I will just give you an overview. It's better to read if you are not able to understand. Once again, I am repeating, you can contact me on WhatsApp or you can comment below. So I will check your comments and will reply each of you. So these are the important things which I have highlighted, or you can say copy from your past paper exam. So these are very important things. Please don't ignore. Best wishes for your exam. Take care.